Hey everyone, welcome to today's Explainer. We're diving into something totally foundational for your personal finances today. We're talking about making your cash actually work for you instead of just sitting there and slowly losing its purchasing power. We're going to break down the critical differences between high-yield savings accounts and your traditional run-of-the-mill banks, pulling some really fantastic insights directly from FinFlow Media's wealth-building principles. If you've ever looked at your bank account and felt like your money is just sitting idle, doing absolutely nothing for your future, well, you are exactly in the right place. Let's get right into it. 0.01%. Just let that sink in for a second. It's a stark, almost unbelievable number, but unfortunately, it is the harsh reality for millions of people. This is the abysmal, and I mean abysmal, average savings rate currently offered by those traditional big-name brick-and-mortar banks. You know the ones. You work incredibly hard for your money, right? You do the responsible thing by putting it away for safekeeping, and in return, the institution holding your cash offers you practically nothing. It's honestly just an incredibly inefficient way to store your wealth. To really put that tiny percentage into perspective, let's say you set aside a starting balance of $10,000. That is a significant amount of money for anyone. But if you leave it in a standard, traditional account for an entire year, your interest earned is a grand total of $1 single dollar. Yep, $1 for an entire year of holding $10,000. And this brilliantly illustrates the real problem here. While your money just sits in that account earning practically zero, inflation is quietly stealing away your hard-earned cash. Your money is essentially rotting away. It is literally losing its actual purchasing power day by day. Okay, let's dive into this because there is a very clear solution to this problem, and it's the hero of our explainer today, the high-yield savings account, or HYSA. It's simply an online account that functions exactly like your standard savings account, but with one massive, game-changing advantage. It provides vastly higher interest payouts. It's the exact same underlying concept of setting money aside for a rainy day, but it's structured in a way that actually respects the value of your capital. Now, I totally get it. A lot of people get a little nervous when they hear the word online combined with their life savings. But moving your money doesn't mean compromising on security or access. Take a look at these three key features we've laid out here. First, these accounts are completely safe. Second, they are highly liquid, which just means you can easily transfer and access your cash exactly when you need it. No jumping through hoops. And third, they are government insured, just like that big bank down the street. So moving your money into an online high-yield account does not lock your cash away, and it definitely doesn't expose it to crazy risks. It is just as secure and accessible as what you're already used to. Now, what's really interesting about this slide is when we actually contrast traditional brick-and-mortar banks with these online high-yield accounts, we aren't just talking about a tiny fraction of a percent difference. No way. Online rates are frequently 10 to 40 times higher. Let me repeat that. 10 to 40 times higher. This isn't just a minor optimization, it's a massive interest multiplier. It means that instead of your money just stagnating and dying against inflation, it is actually compounding every single month, actively growing your financial foundation while you sleep. So you are probably asking yourself right now, wait, how in the world can these online banks afford to offer such incredibly high payouts compared to the massive banking giants? Well, let's walk through the logic step by step. Step 1. Online banks do not have thousands of physical branches. They don't have to pay for expensive real estate, fancy marble lobbies, or, those complimentary lollipops on every street corner. Step 2. Because they don't have that massive physical overhead, their operating costs are drastically lower. And step 3, they take those huge savings and pass them directly to you, the consumer, in the form of much higher interest payouts. It is a highly efficient financial mechanism that works directly to your advantage. It's a total win-win. As amazing as a high-yield account is, let's move to this next point and see how this builds into your broader financial strategy. Because we need to be totally clear here. An HYSA is not meant to replace long-term stock market investing. It's just not. It's not a get-rich-quick tool, and it absolutely shouldn't take the place of a diverse, long-term investment portfolio designed for your retirement. You really need to view this account as a specialized tool. It has a very specific, highly strategic purpose in your overall financial playbook. So the crucial point is, despite not being a vehicle for long-term stock market growth, a high-yield savings account is absolutely the best home for your 3 to 6 month emergency fund and any of your short-term savings. You really need that 3 to 6 month buffer to be completely safe and totally liquid for when life inevitably throws you a curveball. Stuff happens, right? But instead of letting that safety net rot away against inflation in a traditional bank, this account ensures that your vital cash is actually compounding every single month. Ultimately, it really comes down to this core message. Stop letting traditional banks profit off your capital for free. Seriously, They are taking your money, they're lending it out, and they are keeping all the profits while tossing you absolute pennies in return. It's time to move your liquid savings into a high-yield account today and actually make your cash work for you. And as we wrap up this explainer, I want to leave you with one final kind of provocative thought to chew on. If traditional banks are so willing to take your growth right here, right out from under you, where else are they shortchanging your financial foundation?